Hello, ladies and gentlemen. Welcome back to another video. First things first, I want to say go GameStop warrants. These things are up 70% off the lows, and all of a sudden people are realizing this is not a piece of crap retailer. Yay. Now, before we dive into today's video, I did want to say this is not financial advice. Please do not misconstrue anything I say to be deemed as such, and I am not a licensed financial advisor. With that understood out of the way, let's dive into today's video. Michael Burry's algebra-based formula has some insane price targets for GameStop, and I say that a little tongue-in-cheek because disclaimer, you can plug in certain inputs and get certain results. But even if you err on the conservative side, and bears are going to hate hearing this, it's looking pretty good for the piece of crap retailer, according to Ryan Cohen. So we'll get to that in a second. I just want to say first things first with the warrants, they are up big time. If you don't understand why, I will have a link to my full video on the warrants that I made yesterday, and it essentially gives 3 or 4 reasons definitively why the warrants move. I wanted to add one quick more topic to that. If you don't know what Greeks are in the options world, read them. For warrants specifically, there's a concept called vega. It implies it moves with implied volatility. So when implied volatility goes up on the underlying, which is GME, typically warrants will move in a strong direction. They are more sensitive to vega as well. So warrants, I prefer to options. It doesn't take a rocket science to figure out why, because you're not going to have them expire worthless necessarily. So that is my little quick tangential note there on the warrants. And I think too, it's really nice to just pause for a moment and reflect on how good that feels without getting, overly excited. But the months and months of downward price action on GameStop, including the warrants, which were down 35-ish%, it doesn't feel good. So in these moments, it feels really, really good. Now, quick thing too on the warrants, if you look at the order flow, there's just not much there. So watch my video I made on these. Why do they move? It's not because, like I said, some Joe Blow's sitting in his parents' basement bopping in an order for the warrants. That's not what causes them to move. So don't listen to the TA grifters and this, that, and the other, and the people that say, oh, the market's healthy. There are mechanisms that force these things to move, and I will also caution you that they don't just go up. They can come down too, but I think everyone here understands that. So let's get into Michael Burry. This is pretty insane stuff, and I will post it for you. I will kind of give you a recap, a higher overview of what I'm looking at here for Michael Burry's formula. So I think these graphs do a great job of outlining what Michael Burry looks at for his valuation models. Now, we'll go over, this is a conservative approach right here, including a bear case. And you're going to see 3 bars in the top left of your screen. This is intrinsic value per share on the left and intrinsic value by growth scenario. This is the kind of perfect encapsulation of what Michael Burry looks for in companies with his exact formula as used for the inputs here. So in a bear case, this model, and I'll walk you through, we'll kind of, I'll show you the math so you know it's right, but we'll kind of walk over the nitty-gritty algebra stuff here because I think a lot of people are going to conk out probably like they did back in university class. Some people probably love math too. Shout out to those people, but for the sake of everyone's best interest, let's look at some prices here. So in a base case scenario, if things stay relatively on track for GameStop, right? Just considering that they have free cash flow that looks pretty healthy next year, nothing insane in their increases, a business that has stabilized and adds just a little projected growth. You're looking at a base case scenario of roughly $30 per share. And I want to stop right there and interject and say, I had a tweet recently, I posted on X that the warrants have a strike of $32 a share. Both sets of bonds are in the high 20s, between $28 and $30 essentially. What does that tell you about institutions and their willingness to purchase GameStop at a future value at roughly $30 or higher a share? Well, it says that this model that Michael Burry is using is pretty much what these funds, whether they're quant funds, whether they're bond traders, ARB decks, people that are interested in buying warrants, whatever valuation you're doing, $30 a share seems rather conservative for a base case if Ryan Cohen and GameStop Corporation kind of steady the ship, which they've already done, and continue just to chug along with their 5% interest on their cash pile in a money market, right? That seems relatively okay. Now, the other thing that's interesting here about this as well. So, when you're talking about, people get upset at that, by the way, that institutions, are signaling that they would like the right to future GameStop shares around that price. Well, there's also the bear case that is dilutive in nature with the bonds, right? That's going to add more shares to the float. And that is what it is. I think if you've been around GameStop long enough, you know that dilution and GameStop's growth are kind of going hand in hand, which is ironic because dilution for a company that has higher revenues typically isn't a great thing in most cases. But for GameStop, they had to become profitable. So when anyone's going to talk to you and bark up that tree of, oh my gosh, the sky's falling, we've been diluted. Yes, it's not fun. But ultimately, when you have models like this, like Michael Burry's, and you start plugging the numbers in, well, it's awfully conservative now, and it's awfully a safe business. So the bear case here is around $17.87. Let's just call it 18 bucks. I'm going to pull up the GME chart and show you where GameStop bounced off of recently. Friday, November 21 of 2025, it bounced off a level at 1961. And this is an incredibly deep low from, the context of, which is crucial. I mean, people in Wall Street pretend that, GameStop deserves nothing and there's no context for this company. Well, I'm going to add the context in because now it fits the bull's narrative. It doesn't fit Wall Street's bearish narrative anymore. It fits the bull's case, which is 5 profitable quarters in a row. I say it on almost every single video I do. Why do I keep saying that? And I hope they have 6 here in their Q3 report. Is because there is no explanation for why a stock that's relatively safe now by Wall Street's own standards with their cash reserve would be beaten down like this, right? Their earnings per share is going to continue to be healthy just with their cash pile earning interest alone at 5%. It's simple math. You don't have to be an MIT scientist to go through the weeds here and punch these numbers in to figure it out, right? So it bounces off that key level, which, also kind of supports what Burry's calculation is. I mean, that's, a couple percentage points, yes, off 18 bucks, right? 7% down from there, but you're in the wheelhouse. And I think when you're doing future projections, and we'll get to the insane price targets here a little bit later in the video, let's keep expectations kind of in line. Now, the optimistic model here, and for the bear case too, I mean, $17, $18 a share, that's when I can at least entertain the buyback conversation without spitting out my coffee. Now, the buyback, I can probably do a full video on this at a later date. I'll give you the TLDR, or the too long didn't watch, TLDW in this case, is buyback makes sense for companies that continuously produce high revenue every quarter. GameStop needs to increase its revenue. And then you're going to start seeing these Michael Burry models spit out some incredible prices for GME, which I think personally I don't use, by the way, I want to give my personal opinion on this too. I don't really use Michael Burry's valuation. It only makes me more bullish for the company. And there is a bear case. And that's why we're talking about $17, $18 a share in a buyback scenario. A buyback to me would have been initiated at $10 a share back in March and April of 2024. If the company and Ryan Cohen were serious about buying back shares, they would have done it then. Now, is that what Michael Burry is going to recommend for his big GME reveal, which hopefully is a position? I don't care what he says. He needs to have a position. Put your money where your mouth is, Michael Burry. Buy into GME if you're looking at your own valuation here and you're liking the numbers. Buy into GME. And yeah, give Ryan Cohen an idea. Hey, here's an idea, deploy the cash here, or, do this mechanically, do a share recall, whatever it is. I don't think it's going to be a buyback at $22.92 a share. Okay, I just don't. So let's get that out of the way. Let's put a bow on that one and move on. Now, the equity breakdown base case here, total equity value. I mean, you're going to look in the bottom right here and see some big, big numbers, that you think that GameStop can achieve. And this is the funniest thing to me is that the bears somehow think that this is not accurate. This is a conservative model. And in an optimistic scenario, with their free cash flow increasing, okay, they're going to be up at $61 a share. That's with the float being diluted, $61 a share. So let's just take these two numbers, and we'll go through the math here in a second, get to the insane price targets after that. But let's just go, okay, where GameStop is today. Let's say you just woke up and you're looking at GameStop Corp as an investment. Well, if you look at it, $22.90 to $30, that's 30% upside right off the base. 30% upside. I mean, GameStop could realistically touch that if they have a big earnings report. If they had $1 billion in Q3 reported, it could touch $30 right then and there. That's 30% upside. Now, if they miss, yeah, we could be looking at the base case there, 18, 17, whatever, but, and that's 20% down. Still, for traders, that, usually represents higher upside capability. So that's possible. Now, $60, you really got to zoom out on the chart here. $60 is the price GameStop obviously hasn't seen in some time since Warren Kitty was back. 161% upside. And the other thing that I wanted to urge people to wrap their head around with Michael Burry's calculation is it's strictly fundamentals, right? You're not talking about the mechanics of the stock market. You're not talking about fails to deliver. You're not talking about ETF creation and redemption. You're not talking about gigantic notional swap rolls in excess of $250 million per swap, potentially, if not higher, right? That's what the bonds signal. The pricing of the bonds and upsizing the notes. What did that signal to me? Well, that if someone's trying to get out of a swap and they're trying to do it over the course of several years, they're paying upwards of $250 million to do that. Okay, so put 1 and 2 together. What does it equal? Or 1 and 1 together. What does it equal to? The bears are going to tell you it equals 15 because they hate the numbers. They hate the data. Anytime you bring this up, their mind explodes. They can't comprehend it. And I'm not saying, look, macro could flip upside down. Japanese carry trade could go poop. And guess what? GameStop stock's going to go down. The bears are going to be like, yes, until Ryan Cohen pushes the little red button on his desk. I hope his desk literally has nothing on it but a red button. He pushes the red button, goes along equities, U.S. equities. They go up. He times the bottom somewhat in the realm of possibility. And GameStop is the next Berkshire Hathaway that doesn't sit on their hands tied together like Warren Buffett did with 300, however many billions or millions of dollars he just sat on, didn't deploy it. And GameStop is going to be the company. So bears either way, you're looking like you're running out of narrative here. And this is not gloating. GameStop's at $22, which I think is extreme deep value. But let's just take a look here at this thread. This is from Morgan Hatton. So you can see the upside there, $62. That's good. Now, the formula here, you can go over it yourself, looking at discount rates, growth rates, dilution rates, the exact inputs. You can do this yourself, and you can do a whole variable amount of input. So if you don't like certain numbers, if you think those are too high or too low, do it yourself. But you can see free cash flow, 136 million. That's not that out of possibility. Discount rate, 6.6%, dilution rate at 0, and growth rate at 5%. 5% growth. Okay. People have been YOLOing into lunar power packs for 2,500 a rip. That's better than hardware sales. They're going to make more money on that than they will slinging consoles. So take the Switch 2. That's all well and good. That's a key part of this thesis for the next, and it has been backdating 6-7 months now, but future spanning another year and change as well. The Switch 2 is going to continue to sell. They barely have any reputable games out. Just imagine when that picks up. 5% is very conservative as a base case. Remember, the base case is $30, right? Base case is $30. That's intrinsic value is $30 a share, okay? Optimistic, you plug in 6% growth. Think about the people YOLOing into power packs. Think about the streamers that are going to YOLO into power packs. Think about the flurry that's going to create. That comes out to $61 a share. Okay, these are still that you might even be saying 6% growth is conservative. Just imagine if Ryan Cohen deploys the capital. 10% growth, plug in 10% growth. What are you going to get? You're going to get a number higher than $61. Okay, and I'm not saying this to jack anybody up or do this and that, but their cash reserves have accounted for a lot of this potential upside here. $10.64 per share in net cash. That's 50% of the stock price today. What's the cash per share times 2? Do the math. I mean, you're looking at tremendous opportunity here, in my opinion, which is not ever financial advice. So massive cash pile, downside protection. Okay, strategic deployment. They're protected. Sorry, bears, they're protected to the downside. Zero dilution. Now, this is the one where, let me know your thoughts in the comments. Is Ryan Cohen going to dilute again? Well, he's authorized to by us, the shareholders. He is authorized to do more. Are they going to offer preferreds? I hope they don't offer preferreds. If they do, I hope he finds someone much smarter than Michael Saylor to talk to that about, because I don't want to go on a strategy rant right now, and it's beaten down in the Earth's core as well. So let's not throw stones in a rock in a glass house here. I hope they don't do preferreds. I'll leave it at that for this moment here. Profitability, 5 consecutive profitable quarters, 131 million net income, free cash flow positive 130 million. Okay, that's 31% upside in a realistic scenario. Now you got it. Let's just give the bears let's move to the big target in a second. Let's give the bears just a hint of respect here. Revenue decline. Yeah, physical retail is obviously declining, hence power packs. Execution risk. Can they pull off the digital transformation? Well, I would just say power packs, there's a lot hinging on it. It's certainly been a better rollout than their NFT marketplace. Let's just check that off as probably a safer comparison than the NFT bomb. Competition, Amazon, Walmart. I'm not seeing Walmart do anything in this space. So I'm not really sure that Amazon, I concede they've got a better thing going there. It's basically a cloud storage company. It's not a random scribble. It's framework for finding value. Yes, it is. And this is at the end of the day, and let's get into the formula now. Fair multiple equals 1 divided by required return minus per share growth plus dilution equals buyback yield. Now, hold on to your seats, buckle up. I've turned on the fasten the seatbelt signs here, to use a cliche. This is where, if you get a little bit more growth minded with the numbers, and if you say to me, hey, I love what Ryan Cohen's doing, I love Larry Chang's advice, I love Nat Turner on the board, I think they're going to cook up something pretty big time here, a Michelin star meal, if you will, then you're going to start to see these kind of numbers. So let's take a look at this. And again, keep in mind, GameStop around $23 a share right now, okay, with 5 consecutive profitable quarters. You probably hate hearing that already, but okay. So stock-based compensation. What has happened to GameStop's stock-based compensation over the past few years? It's come down. It's come down a lot, okay? It was 10 to 15% of operating cash flow, which is terrible. That dilution, because if you don't know how this works, as an executive, I agree to a lower salary and get compensated with stock. Well, every time I get compensated with stock, that dilutes the float, okay? We don't want that. Okay, take a low salary and don't do SBC, okay? If you really believe in the turnaround of this company, buy your own shares. I'm not pointing fingers, that's not directed at anybody on the board. But okay, 10 to 15%, that's not financial advice. So completely overwhelmed, any modest required return, say 8 to 10%. That negative per share growth from declining business, plugging in the numbers, yielding a fair multiple of 14 to 16x, matching the stock's actual trading range. Okay, so SBC has come down, right? Let's fast forward to now. 10Q tells a different story now. 8.7 billion in cash equivalents. Yes, some of that is debt. That's another PSA. I would side with the Wall Street analysts. The only time you're going to hear me say that on GameStop's cash, you have to look at the bond cash as debt. It's free debt, but it's debt on a balance sheet. So, but this is right. 8.7 in cash and cash equivalents, fine. With SBC to only 1.1%, that's a massive decline. Dilution drops from 12 to 1%. Required return 8 to 10%. Okay, so that's a little higher. And then per share growth turns positive at 10 to 16%. Okay, that's 5% cash. There you go. So are they going to repurchase shares? If they do at a 12% annual rate, dilution flips negative to 11%. Okay, this is where Burry's value formula starts to spit out infinite. I'm not trolling you. This is infinite value. This is not deep value. This is infinite value according to the formula. Again, don't get mad at the numbers. This is the formula. Now, would they buy back the shares right now? No. If the market collapses and things come down, then they should buy back the shares. Period. Point blank. Period. Not even a thought in my mind. The other thing I wanted to quickly interject here, critical. Ryan Cohen, via legalese, cannot initiate a short squeeze for this stock. The company cannot initiate a short squeeze. If the reason they buy back shares is to initiate a short squeeze, or if there's any misconception, or if someone misconstrues it as such, they're going to face legal penalty. They're not going to do that. I have commenters being like, Ryan Cohen should squeeze this thing. No. He should grow the business. The stock price will take care of itself. Do not put people and the company in a legal nightmare scenario by forcing a squeeze on the stock. That is nightmare fuel, man. Okay, I can't even believe we need to talk about that. Think of a fiduciary, right? Why did Michael Burry sell his position? I have people saying that too. Oh, Michael Burry paper-handed the bag. He made $100+ million on the GME trade. Okay, I mean, he's a fiduciary. He was at that time a fiduciary. Now he's a Substack salesman. He was a fiduciary. You have an obligation to make money in the best interest of the people supporting your fund. Okay, enough is enough with this whole he paper-handed. Could he have made billions? Yes. Okay, but he didn't. In short, let's not get greedy here, folks. The same valuation framework that perfectly explained why GameStop was stuck at 14 to 16x from 2019 to 2023 now explains why the stock can rationally trade at 50 to 200x forward earnings. Now, that is extremely high. I don't want them to do buybacks. That's just what happens if they do. Let me know your thoughts. Should they do buybacks? Is this absolutely nuts with this formula? Okay, between 48 to 110x, so a little bit lower than this range. Price per share would be $42 to $95 before buybacks. That's with PE of 2620. So even without buybacks, you can have this formula spit out some mega numbers. Let's just look at 96. And my personal price target, I'll tell you right now, listen up. Just kidding. I'm not, I have a number in mind. I'm not willing to go there just yet, but you can see that would be 300+% upside. And the bears are probably in shambles right now thinking about that and can't even wrap their heads around how a brick and mortar retailer could do such a thing. Don't take it up with me. Take it up with the numbers and take it up with Michael Burry. Okay. Shout out to Simple Jack on X. This is a good post here. It's a little mega bullish for me. But it's just a simple equation. Plug in the numbers, see what you think GameStop free cash flow is going to be. If you think they're going to do buybacks, you could see some crazy things here. Now, interesting things to wrap up the video. And I wanted to touch on the model too, at the tail end of this, because the model is saying something interesting. Before we, sing Kumbaya around the campfire and, dance in the rain here. GME 25 strike calls expiring December 19th, 2025. Big trade, 6,500 contracts purchased at the ask for about $500,000 in premium. This is clearly an earnings gamble. I say the G word because it is possible that Ryan Cohen and company have a bad quarter. I highly doubt it. Think about the possibility of this too. This is not something I talk about. If you're still watching the video, kudos to you. I'll entertain this for you guys. Think about the possibility of him selling Bitcoin at a 15% gain. Think about him selling the Bitcoin. Now, the tax nightmare and the accountant and working overtime with the cap gains, yes. But think about the possibility of that and then him buying it back in the $80,000 range. And think about them trading Bitcoin. Yeah, it's a tax nightmare, but just think about what happens. Anyway, it's possible. It's possible that their revenue's lower. It doesn't look good, whatever. I highly doubt that. It's also possible that Ryan Cohen dilutes off a good report. It's also equally possible. But this is a mega big options trade. You haven't seen a lot of this lately. I think it's very interesting to track this. They obviously, it's funny, they bought those cons when GameStop was already up, I think like 2%. And then, share price came down. So this is a big options trade to keep an eye on. I do not, by the way, like to play options around earnings unless it's a very small amount of money that I'm willing to throw out the window. Okay. There's nothing to me that suggests that this would be worthwhile, especially when now you have the warrants available. Yeah, it's just not, doesn't make sense. Okay, so let's look at the model. Interesting couple of things here going on. Look at the XRT in this far right column here, all of the green. They are steadily creating XRT shares. This is what you want to see. This is what makes GameStop, in my opinion, one of the reasons why price increases. They're going to have to fill it up. They create shares. It's better for GameStop when they create XRT than when they redeem it. It's in the data. Just look at the numbers. Okay, don't come for me. The model. Let's load up the model here now. Very, very interesting. The person on Reddit, on Super Stunk, that's updating this, has a little graph here on the top right, pointing to an interesting time, April of 2024, right before GameStop shot up to $80 in pre-market. That's, I think, what they're saying this time is like. I'm not seeing that personally. The model's not either. The model is saying a rip up to, and it's tracking pretty well now. It's kind of done the same pattern. It didn't really account for this downward pressure here, but if you think about it, the model topping out here, okay, and kind of coming straight down, like it had a blip here that didn't happen. Maybe there's going to be 2 blips here instead of just one, and that's setting it up closer to 30. But the model is topping out at the exact 26.44, okay, and then kind of trading flat and coming down into January, which is suspected big swap season. So the person in here is putting the April 2024 fractal or a pivot in here. It could be, that would be awesome. Warrants would be up, probably 1,000%. Underlying would be up a ton. People would be elated. They'd be over the moon. And then Ryan Cohen would probably dilute, to which he should at that price. But point being, I'm personally forecasting 26, 27-ish dollars. Hopefully the warrants run up even further. Will I trim a little? Maybe. I really want to hold on to them. I really trust Ryan Cohen and company. I just want to say too, if GameStop comes down into January, the warrants will come down too. And, you don't want to be that like, ooh, should I have done this? So when I look to sell some covered calls, yeah, I would, if IV keeps rising and I don't think my shares are going to get called away, I would do that. That's not some grave sin. Anyone that tells you that it is does not have your best interest in mind. And I'm not speaking for anybody else. I'm speaking strictly for me. I used to buy into that narrative. I do not anymore. So that's the video. Michael Burry, $95 price target with his formulas. Nuts. That's not his price target. That's just his formula with certain inputs. Like I said, let's tie it back to the beginning of this video. You can put in any numbers you want, and it's going to spit out different numbers. Base case 17, upside 95. That's a wicked big range, to quote someone from Boston. Me personally, I like to remain grounded in reality. Burry's formula only makes me more bullish on GameStop Corporation.